Welcome everybody. Happy Tuesday. Hope everyone's having a good day. Got a lot to cover in the markets today, including the news that the Bitcoin Greed and Fear Index has hit the second lowest point ever. Wild news. We'll get to that in a sec. First, don't forget to hit the like and subscribe button if you like what you're seeing. And remember, you can always skip around using the timestamps in the bottom of the screen near the video description area. Let's begin. Markets. Right around 30,000, not too much movement, kind of flat on the day. It does indeed look like 30,000 is the temporary floor price the market has found. That doesn't mean it's going up or down, but it just means until the market decides which direction it's going in, 30K seems to be the floor price. Greed and Fear, on the other hand, it went down again. It's kind of been all over the place. It was at 9 or 10 over the weekend, then it went up yesterday to 14, and then back down to 8 today, second lowest point ever. This is what happens at a bear market. One day investors are optimistic, the next day, irrationally, they just turn to be extremely pessimistic. This is normal. Sometimes time is the only thing that gets a bear market out of the bear market phase. So yeah, 8 on the Greed and Fear. That is the second lowest point ever, the lowest since March of 2020, the pandemic era. So if you look here, so here's where we are here, if you can see that beyond the video of me. So 8, and then the last time it reached this level, 8 exactly, was in March 2020, right when COVID hit. That's, to be expected. It would be a very low Greed and Fear reading then. And then the only other time it got lower than this was 6 in August 19, when it fell below a psychologically critically important $10,000 BTC threshold. So there is a lot of fear in the marketplace. When there's fear in the marketplace, tensions are going to be on high. A little crypto Twitter crypto beef in here going on. Crypto and Michael Van de Pope, two European influencers, two technical analysts, similar size followings. Apparently they don't like each other too much. Crypto tweeted this yesterday. Will Luna reach $1.20 again? Yes, maybe, no. Vote. Michael Van de Pope responds, dude, this is by far a tweet that deserves an award for stupidity. Twitter beefing. It's the Luna $120 tweet. It might have been a little reckless, that tweet, but still, markets are down, tensions are going to be high. This is normal. Classic sort of old school Germany-Netherlands rivalry. Can't complain there. Keeps Twitter fresh and exciting. Moving on. Institutions, and this article is a little misleading here. So it shows institutional investors accumulate a staggering $298 million in Bitcoin, essentially as investment trust products see massive inflows of that amount. So these are the crypto investment trust products. We've been over these before, like Grayscale, 21 Shares, Purpose, ETC Group. So for last week, or the last 7 days, net inflows outweighed net outflows by $274 million right here. And then since these are only long products, these are not short products, this is all buying. So the headline would seem to indicate that institutional investors are buying to the tune of $274 million. The article goes on to say it's mostly came from North American investors, just a little bit in Europe, but this kind of makes sense because it's a U.S. investment trust product. The Asian investors have their own investment trust products. There are some other ones in Europe too. But now if we look a little closer here, the headline was a little misleading because of the $274 million positive net inflows. Look here, pretty much all comes from this one fund, $284 million from the Purpose Bitcoin Fund. And then if you look at Purpose's with the weekly inflows versus their monthly and year-to-date inflows, this is just an anomaly here. It's not like this is a one-off thing. It's not like they get every week $280 million. So this was just a one-time infusion of cash into the Purpose Long Bitcoin Investment Trust Fund. Came from one institutional investor, obviously. That's most likely either a university endowment fund or just a individual billionaire whale investors just diversifying his own portfolio. They are buying a dip here since these are long-only products. Smart money. I mean, if it is a university fund, $284 million, they would have to have probably $5 to $10 billion in total endowment money at least to be diversified enough to put that amount in. And pretty much the only schools that have $5 to $10 billion of endowment money or more are the Ivy League schools, the top 10, top 15 schools. So if it is a college endowment fund, which I think it probably is here, it's smart money. So they're buying the dip. It's bullish. Moving on. Well, Kamani puts out some good stuff. He puts out this here that, interestingly enough, Asian trading premiums, the trading premiums during Asian market hours versus North American or European market hours, they're at a premium right now. They're at the highest premium in the last 2 years since July 2021. So this doesn't necessarily mean, this isn't indicative of buying or selling. It just means Asian traders are very heavily trading now. They're very heavily involved in the markets. But we can get some clues if you look here. So it's the second biggest time in 2 years that the funding that the Asian premium Asian trading premiums have been this high. The only other time that it's been this high in the Asian markets was July 2021, which was a low point. So that's a good sign. Basically, the Asian traders become very invested in the markets when we're at a market bottom. They're basically buying the dip. So this is a bullish sign right here. If the trading premium was at a high during a market high, like November of 2021, this would have been a negative sign, but it was during a market low, July 2021, that the last time the premiums were this high. This is bullish. Moving on, CZ, he put out this tweet here. So he's just kind of clarifying Binance's investment in Terra. So they invested $3 million in the 2018 round. They did not invest in the 2021 round. And then that $3 million turned into $1.6 billion. And then they did not sell any over the last week when Terra crashed. He even gave their wallet address to show that the money did not move at all. But this tweet really just got attention because, I mean, just look at the eye-popping returns in crypto. I mean, $3 million turns into $1.6 million at a Terra investment in only 3 years. It's 560 times return. I mean, name another industry that has returns this high. Just amazing. It's no wonder there's so much money, so much VC money coming in, because the returns are just crazy. Sam Bankman-Fried, Terra, he said, Terra is a case of marketing and memes gone wrong, according to FTX CTO Sam Bankman-Fried. Sure about that, we'll see. Next article, investors withdraw over $7 million from Tether. So this is interesting. So it shows in the last day, since the Terra debacle happened, investors were selling Tether in record amounts. That's just kind of normal. They're going to be spooked from any stable coin temporarily. So by selling Tether, they obviously weren't buying any other stable coins. They were obviously selling it into Bitcoin. I guess they also could have been selling into fiat, but I'd have to assume most of that $7 billion was Tether being sold into Bitcoin, meaning you would think the markets would have gone up last week. $7 billion of BTC was being bought, but it didn't. It remained flat or went down a little. So it just goes to show that even with the $7 billion of BTC purchasing, there's a ton of selling, which pretty much outweighed that and caused the markets to go down a little bit. So now the state. So who will remain the sort of leaders and go-to stable coins from now on? So in my opinion, you have two pretty good options here: Tether and USDC coin. So let's look at how they're similar to each other and then how they're different from Terra. So Terra was an algorithmic coin, has been over by now. Tether and USDC are both. They're not algorithmic coins. They're backed by reserves. Now, Tether has famously been not so transparent about what exactly the reserves are and where they're located, whereas USDC coin, they actually have been very transparent. They are backed by Circle, which is a Boston-based financial services company that's been dabbling in crypto on the peripheral for a long time, since about 2013, 2014, actually. So even though they're kind of quiet, they have been around crypto for a while. And they're very transparent. They've showed exactly where the reserves are. It's a mix of cash, short-dated U.S. securities. So they have the advantage over Tether in terms of transparency. On the other hand, they haven't been around as long. USDC launched in late 2018. Tether has been around since early 2015. So Tether has sort of the long-lasting advantage. They stand the test of time better. Tether, and they were founded in part by the Bitfinex founders, which, love them or hate them. As I've said many times before, they do know the crypto markets better than most people. They've been around a long time, since 2012. They trade well. They just know the crypto markets work and move. So in my opinion, yeah, you have two great options here. One's a little more transparent. If they both went under completely, you'd probably want to be in USDC coin because, you'd be getting your money back since the reserves are transparent. But if one of them had a slightly less chance of crashing in the long run, it would probably be Tether, just because they've stood the test of time better. Two good options there, in my opinion. Move on. Coinbase. So they have announced they're slowing their hiring efforts amid market concerns and the broader crypto downturn of Q1. So they're not firing people. They're not laying people off. They're just slowing their hiring efforts a little. I think that's probably good news. Now it's probably a good move. CZ and Binance, they are doing the opposite, though. They are hiring aggressively, CZ tweeted just today. Then again, Binance is just pretty much always doing well, so they just kind of make their own rules for themselves. Global macro conditions just don't seem to affect Binance. They're just always going to be hiring. FTX, they haven't said whether they're hiring or not hiring, but they have been spending a lot. As I covered last week, they put $650 million into buying a 7% stake of Robinhood, so they're spending a lot of money. Will this pay off or not? It's tough to say. FTX, amongst the big exchanges, they are still the new kid on the block. Remember, they've been around 3 years. They do have the youngest founder by at least a decade. So is this reckless spending or is it good spending? Who knows? Only time will tell. And then Crypto.com, as I've covered before, they've been cutting costs slightly. They cut their card staking rewards and reinstated them the next day. That happened about a week ago. So they ended up not cutting costs there, but it does go to show that after their $175 million Staples Center naming rights move of about 3-4 months ago, they are kind of slashing costs slightly. That's that naming rights deal at the time. It was, some people did raise their eyebrows a little. The crypto markets are pretty wishy-washy. They can change very quickly from 1 month to the next. So a 10-year naming rights deal, when you don't really know if you're going to be the leader in the market in the next 6 months, 1 year, it's a little risky, but they're not making any drastic moves here, just minor cost cuts. That's it for today. Hope everybody enjoyed the episode. Don't forget to hit the like and subscribe button if you did enjoy it, and I will be back with a new episode tomorrow. See you later.